about to hear my conversation with our head of fixed income, Constantine Bomer, where we'll discuss, amongst other things, the outlook for the Canadian economy, as well as the Bank of Canada's approach in 2025, what the fixed income markets are expecting from a Trump presidency, as well as where Constantine and the team are finding opportunities across the globe. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction in Mackenzie Private Wealth. Today, I am joined by Constantine Bomer, who is our Head of Fixed Income and Portfolio Manager on the Mackenzie Fixed Income team. Along with Constantine, we're going to discuss his outlook for 2025. Constantine, thank you for joining and welcome to the podcast.
Thanks, Rajan. Great to be here.
Excellent. Let's jump right into the questions. Constantine, I'm speaking to you early 2025. I've been consuming a lot of the outlooks across the industry. I'm going to get to your view on central banks in a moment, but I actually want to start with your take on the Canadian economy. Now, the last time I spoke with you was in the fall. You made a number of great calls, and one of the things that we talked about was how the Bank of Canada was behind the curve, but that was all mainly because, in your view, Canada on a per capita basis was already in recession. Many of your calls have proven to be quite prescient, so I'm curious, as you look at the Canadian economy right now, how do you view it if we look out 6 or 12 months?
Yeah, good question. It's not looking good, that's for sure. So I think like the same issues that we've had back then are still here. We have low productivity. You see unemployment rising. We're just not creating enough jobs for the amount of people that we have in this country. Infrastructure is poor and getting worse. I think sentiment is weak, so just the energy is lower than maybe a few years ago. So, and then you have on top of that, you have the threat also with tariffs coming from the US now, political leadership vacuum. So there's a lot of areas in Canada where we should all be concerned, but we're right. Part of our job is to look at like countries or look at the fundamentals, look at what is going on in the areas that we invest in. But another one is also to assess how much of that is already priced by the market. And if I look at Canada, like it is very hard to find anyone who is not pessimistic about Canada, right? This is complete base case for pretty much everyone in the marketplace. And right, it is that can possibly also create opportunities going forward.
Excellent. It's a great way to kick off our conversation. You talked about, base case, low productivity, bit of a political vacuum in Canada with the resignation of Prime Minister Trudeau as head of the Liberal Party. We'll probably have an election sometime over the course of 2025. But I wanted to touch on your views on the Bank of Canada. When we chatted in the fourth quarter of 2024, you made it quite clear that the Bank of Canada was behind the curve. This is before we had the first 50 basis point cut. They must have heard our podcast because they've certainly reacted in a more meaningful way now. But for where we are right now, January 2025, do you think they have a better read on the economy, or do they still have to maintain an aggressive posture?
Yeah. So actually, what we have priced in, just checking right now here, it's 60 basis points of cuts priced for 2025. Right, that is 2 cuts of 25 and a little bit extra. That is nothing, right? We're at 325 now. I don't think this is gonna cut it. So I think Bank of Canada has to do quite a bit more than what is currently priced in. Expectations are that we will get another 25 basis point cut at the January meeting, but then it kind of fizzles out and we don't have a clear indication of whether we will get more cuts from that standpoint. My take on this is Bank of Canada will probably cut in clips of 25 basis points over the next few meetings. And I'm thinking maybe the next four, so get another 100 basis points lower in the policy rate. There's a possibility that there is maybe a chance that they will skip a few because we've had those mini stimulus packages at the end of last year with the like adjusting some taxes and trying to get a little bit more growth into the economy by having some fiscal stimulus. But that I don't think this will be a meaningful game changer. And then, as mentioned earlier, we also have that big inauguration threat on tariffs where maybe they will get called into action because that could be another hit to the Canadian economy if there were meaningful taxes to be imposed on Canadian exports. So I think Bank of Canada has to cut more. I would not be surprised to see policy rate at 2% by the end of 2025, and that is a quite well, it's quite a different view to what is currently priced by the market. So that would be 70 basis points of additional easing that the market currently is not seeing. So that could be a positive fixed income year again for Canada.
Wow, 2% policy rate. That'd be quite a dramatic move from where we started. You mentioned the inauguration of President-elect Trump. We'll get there in a moment. I want to stay with Canada for one more question, and it follows on what you just mentioned with regards to the bank's cutting cycle, but also your opening comments on how a pessimistic view of Canada is prevalent everywhere and seems to be everyone's base case. Correct me if I'm wrong, but the Canadian economy is one of the most, if not the most, interest rate sensitive economies in the developed world. Takes a while for these rate cuts to work their way through the real economy, and with more to come. Is it possible as we get into the end of 25, 26, we might see some more encouraging green shoots, or am I just too optimistic?
I don't think you are. I think you're probably too pessimistic here. For real change to occur in the economy, that takes time, right? That is not something that can change from 1 month to the next. We're too deep in that hole that things will not be magically different in a month's time or in a quarter's time. And policy rates are nowhere near low enough to become really stimulative. I think maybe that's something that the real estate agents across Canada hope that it is, but I don't think we're there yet. So for interest rates to be stimulative, they have to be at 2% or below. Like I don't think anything above. That's why I'm like 2.5% is not gonna magically resuscitate the housing market, and nor probably should it, because there's probably also something good in having some correction here because things got a little bit out of hand in recent years, and there has to be some probably has to be some pain. Obviously, I don't wish it on any individual person, but as a for the market as a whole, there were like a significant amount of speculation, a significant amount of exuberation in that market, and that needs to be curtailed to some extent. And money was too cheap for too long. And I think with immigration as it was and a low amount of housing stock, you had a perfect storm of how things got a little bit out of hand. So that seems to be still in place and has to work out. I don't think a few months will make a difference, but what will make a difference, I believe, is if we get a change in government, the perception that people have towards Canada can change very quickly. And that is has nothing really to do with the real economy, but it has a lot to do with assets, Canadian Canadian assets or Canadian dollar assets, where all of a sudden, like Canada is part of the global economy. Currently, the global community is underweight Canadian dollar, is negative on Canadian assets, and that negativity is fairly well entrenched. But if you get a change in government with a real mandate to make some changes, that positioning can change dramatically. And it is that positioning first has to go from underweight to neutral. So that will bring in a fair amount of buyers. And then if the first few weeks and if the election win is decisive enough and if the words are chosen carefully and smartly on how to make Canada future ready, then all of a sudden that sentiment can change quite drastically. And I would not be shocked to actually see the Canadian dollar trade in the low 130s by the end of the year. And maybe it is we go to 147, 148, maybe even 150 before we get there, possibly on some news that come out later this month. But then once we get into the election scenario and have everyone positioned in the other way, there's a good chance that there can be a significant rally in Canadian assets, and Canadian dollar would be part of it. And I think the sentiment towards Canada can change quite drastically. And one good way to look at this is always to try to transport yourself a little bit into the future and imagine we're sitting here and maybe we'll do another podcast in 6 months' time. And we say, how would the world look if we have all of those changes occur, right? If maybe they will put on, US will put on tariffs on Canada, maybe we get a decisive victory of the Conservative Party, which has a mandate to make real changes in Canadian productivity and like roll back some of the maybe policies that international investors are not too thrilled about. And in that environment, all of a sudden, Canada could become one of the most interesting stories because then they align with the US in terms of policies. Trump will remove those tariffs. So you have another kicker. And then all of a sudden, you get just a combination of multiple positive events coming all together. And that is from a positioning where everyone is short. And that can be a massive rally in Canadian assets overall.
Makes sense. I love it. I also love that you invited yourself back to the podcast in 6 months, and I do accept your invitation of yourself. I want to switch over to the U.S. We have the inauguration of President-elect Trump on the 20th. On the equity market, big focus on tax reductions, the impact on the potential boom to small caps. We have deregulation coming, but the bond market at times has had a little bit of a different reaction to the potential rise in deficits and what might be coming from tariffs, because they could potentially be inflationary. What are you seeing and what's your interpretation?
Probably getting to the point that it is overblown. So I don't like, I look at fixed income and like you hinted at in our little chat before the podcast started that we shouldn't talk about like the complicated things in fixed income, but I think we still have to a little bit. So it is like the TIPS market. So those are inflation linked bonds. It is the coolest market in fixed income because it tells you a great story. And the story that that market is telling you is how much do you earn if you don't have to be concerned about inflation, right? You get whatever happens to inflation, you get that. But how much more are you getting besides that compensation for inflation? And that is telling you right now, you get over 2.5% for 30-year US bonds, 2.5% plus inflation. And that is a really, for the safest asset class in the world, still, right? Those are US treasuries. They will not default on their bonds because they can just print the money and pay you back. But it is for the safest asset there is, you get 2.5% real. And that is really good, right? And that is for all the big pension funds out there, for all the long term investors. Sure, can it go to 270? Can it go to 3% even? Of course it can. But we are already in the territory where this is looking really attractive for some long term holders. And that is telling me that the sell off probably will not keep on going for all that much longer. This is a different story than the gilt bond market, right? That market can blow up a lot easier than the U.S. Treasury market. The U.S. Treasury market is the biggest, most important, most liquid, most looked after bond market. There is the bond vigilantes that can change the course of a government. Is so much harder in the US space. I don't think that is in the cards here. I think the valuation argument is coming back, and seeing 30-year bonds trading close to 5%, and then especially when I look at those inflation linked securities, seeing that you can earn real 2.5%, that is really attractive for a lot of people, and that brings in buyers. And if it brings in buyers, I'm reasonably sure that the uh, that we're not too far off from the peak in yields, at least for the time being. So looking at the markets now, I'm probably a little bit more constructive than the market sentiment is around fixed income. So I would, for anyone who has a little bit of a longer term time horizon, already allocating some money to US fixed income
Okay.
makes a good amount of sense.
Excellent. I want to stay with the US, but I want to transition over to the Fed. A bit of different landscape than in Canada. You not only have much stronger growth, but inflation seems to be running hotter. Could I make a strong argument that the Fed might not have much more work to do with regards to rate cuts?
I think that's fair. When we hear from those central bank governors, they're telling us all different stories of how policy rate is still restrictive in the US. It probably is not restrictive. I think it is kind of in the neutral zone right now. If you have wage growth where it is, if you have inflation where it is, if you have growth where it is, like, this is not a restrictive monetary policy environment. So I also don't think there is a lot more to come our way. But then again, right, we have wild cards on the political side. The tails of that the normal distribution are pretty fat because we have just a lot of variability of what can come our way. And as such, my confidence level is not super high that this is the last cut that we've seen. But I think we're on a pause for now. That is a consensus. So there's no real differentiating view that I'm expressing here. But I also would not be terribly surprised if we don't see another cut coming our way from the Federal Reserve.
Okay. And just so you know, I appreciate that you referenced it as fat tails and didn't get into kurtosis. That's very meaningful for me and the audience. So we've talked a lot about central banks and rates. I want to talk to you a little bit about credit. You know, I certainly don't follow it as closely as you do, but if I look at investment grade spreads in Canada and the U.S., but certainly high yield spreads, quite tight versus 10-year average. You're a global manager. I know North American focus for the unconstrained mandate. What are you seeing on the credit front?
Yeah, there's not a lot that you can play for in the credit space. As you said it, credit spreads are tight, but then you also always have to say, well, what are the triggers for this to really change? Because at the end of the day, if nothing changes, you're earning 3% more in high yield bonds than you would earn in government bonds. And 3% is not nothing. So it is still, like, obviously better to earn 3% more. Um, again, if nothing happens, if there is no real credit event that is coming our way, and like the risks of a US recession, which would typically be like the event that would see credit spreads widen significantly, is fairly low. So, like, we don't dislike credit here at this stage, but I also don't think there's a lot more to gain from it. And we have to become a little bit more creative in the way that we try to find yield. And that actually has been the story of 2024, which is credit spreads in the major markets, whether that is investment grade credit or high yield credit, they didn't move a lot. They actually stayed fairly like stable across the year and didn't there was not a lot of spread tightening, but in some of the more illiquid areas or maybe overlooked or not so well covered, in those areas we've seen a meaningful rally. So those would be in your hybrid securities or LRCNs, in maybe even some let's say less followed credit areas of the market which had higher credit spreads to begin with. So it was really that creativity trade that resulted in the great performance also in a lot of our mandates. This was the driver for the performance for our mandates, because you couldn't really get it in the basic markets. You had to look a little bit outside of the your standard wheelhouse to find value, and those have contracted a lot too. So that is something that we're also now looking into very closely, that those illiquid and less followed areas have performed exceptionally well. And there is a point where we also have to sell those again. So that is something where we see a little bit more juice left, but we have to stay flexible and we have to look for opportunities wherever they are. And sometimes they are in more illiquid securities, and sometimes they will be in more liquid securities. And we have to also make sure that we get out of the illiquid ones before everyone else does.
I just have a couple questions for you, Constantine. Just to follow on from what you said, you have to be ready to go wherever the opportunities are. Post financial crisis and for the ensuing, let's call it nearly 15 years, it seemed like everything was synchronous. Central bank activity, synchronized cut cycles. It seemed like spreads moved everywhere in the same direction at the same time. We seem to be in a very different environment now. And even you've talked about Canada and the US, different levels of growth, different types of policy regimes. You just gave great examples with respect to, with hybrids, LRCNs, different spread tightening in different parts of the market. Is it fair to say this is the right market where if you're working with a manager who's taking care of your fixed income assets, they have to have the flexibility to go in different places?
Yeah, I mean, working with a manager like myself, no, joking aside, but yeah, I think flexibility that's the key, because there is no one market which is so good and so attractive and delivers like really strong returns for long periods of times. There are pockets of value and they change, and it is something looks attractive, but that doesn't mean that it is still attractive in half a year's time, right? It is, we have to harvest whenever there's the opportunity to get that performance, and having more flexibility allows us to go into the places where we see opportunities. Of course, there's always like just having the opportunity to go to different places doesn't mean that you will do a good job. You also have to do your research and you have to have the skill set to play in those markets. But if you have the skill set to play in the market and you're able and allowed to engage in those, then I think that is a very good combination of being able to achieve superior risk adjusted returns. And like there are incredible stories out there in global markets. Like I was looking earlier today for a discussion on China with some of my teammates. Chinese bonds have rallied in the last year 100 basis points, versus US Treasury bonds have sold off 60 basis points. So the spread between Chinese 10-year bonds and US 10-year bonds widened by 160 basis points in 1 year. Like, that is gigantic. If you have a 1 year of duration, so let's say a 10% allocation in your fund, roughly speaking, 10% allocation in 10-year bonds, that can give you 160 basis points of alpha relative to US Treasuries. That is, like, those opportunities are out there, and like, Japan is not a different story, right? Where you have one market in Japan where we're hiking policy rates, and then you have other markets in Canada that we talked about where we probably still see multiple more cuts, and then you have the US, which has a high chance that we will see no more hikes or cuts for an extended period of time. And that is exactly the environment that is great for active managers, because you can shift, you can find the places that you like, you can avoid the places that you don't like, and there is dispersion between the different markets, and that is exactly what active managers want.
Makes a lot of sense. My last question for you, on a day-to-day basis, Konstantin, I spend most of my time speaking with advisors from a portfolio construction perspective, and many of these advisors made a great call a few years back, and they put a lot of cash into GICs and high interest savings accounts. And now in my conversations, there's a reinvestment problem that they're looking to solve because we're in a very different rate environment. What's your perspective on how you solve for this?
Now, I think the easiest one is, of course, you go to something short, medium term Canadian fixed income, and I think that's still fine. That's good. Like, especially when you think that Canada will cut a little bit more, like, that's good. Like a short term income fund or so, where you have a little bit of credit spread in there too. It's not pure governments, but it's a little bit some spread products, but also a good amount of whatever govies, provies, etc. in there. So I think that's still a pretty good choice. But then, like, honestly, the best one would be those flexible, unconstrained mandates where you can just say, there's so many opportunities in fixed income around us. Let's try to take advantage of that. And maybe let's not go all crazy in terms of risk taking. Let's not buy a high yield fund, maybe, right? Because going from cash to high yield is a very different animal, but staying in something that still does quite well when there is a more challenging economic environment, but also has the flexibility of finding value when markets are behaving relatively normal. I think that is a good choice for investors to make. In terms of countries, yeah, I think, like, Canada is good. US, I think, is also not too bad. I'm actually more interested in the long end of the US curve as opposed to the short end. So maybe more the 10s and 30s, but that is, again, would be a pretty big stretch going from 10-year bonds into TLT or QTLT as we have it. But yeah, I think Canadian short term is an easy one. Canadian fixed income overall is good. And then those flexible global mandates that can take advantage of different policies of different countries and different parts of their cycle, I think that makes a lot of sense.
Okay, so Canada good, US not bad. But you know what's excellent, Konstantin?
Oh, tell me.
This conversation. I'm going to wrap up our conversation here. Really wide-ranging conversation. I put you on the spot a number of times, and I think you provided terrific context. So thank you very much for joining the podcast, and I look forward to having you back sometime soon.
Excellent. Thanks, Roger.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.